Welcome back to Power Lunch. Sibanye Gold reported improved production for the 6 months of this year. That was compared with the immediately prior 6-month period. But when you have a look at it year on year, doesn't look quite so good. We will, however, be getting the insight into that with Neil Froneman, Chief Executive of Sibanye Gold, who's in fact at the Johannesburg Stock Exchange today. Neil, we were having a little joke earlier, Lindsay and I, saying, we need to twist your arm to do a little bit more exercise. We're actually only 5 minutes away from you.
Yeah, no, listen, it would be welcome. The exercise.
The exercise. Yeah, but you're getting enough trying to fix this business up. Well, I suppose trying to fix is a little bit aggressive. You've had your background in getting gold mines to produce a lot more efficiently. With Bernard Swanepoel, the work that you did back at Harmony, and of course with your own work at Leases, which you then turned into a uranium business, etc., etc. Is this, though, the juiciest plum that you've been able to pick?
Alec, absolutely. These are probably still some of the best gold assets in the world. And when I say best, in terms of gold assets, you rate them in terms of quality, which is normally grade. And if you have a look at these assets are still recovering at 7-8 grams a ton, and they'll do so for the next 10, 15, maybe even 20 years. So these are peaches. These are not even plums.
And these are names well known to those who've invested in South African gold shares over the years. Driefontein, which was Driefontein consolidated after it was East and West Drie, and of course Kloof, one of the richest mines in South Africa, and Beatrix. Those are the three babies that you've got.
That's correct. And as you said, Kloof and Driefontein, high quality mines. Beatrix has been known for many years to be the lowest cost producer in the industry, in the gold industry.
Just to have a look at the way that the market is looking at your numbers at the moment, Neil. Today, your share price is up 6.75%. Harmony is down by 4.5%. Is there, from the discussions you have with investment analysts, a switching that you're seeing going from Harmony, which is still worth 10 billion rands more than the 6 billion that you're worth?
Alec, I'd like to think so, but I don't think that is the case. Harmony was up 20%, I think, yesterday, based on data out of China. So I just think it's a bit of a correction. I don't think it's really got anything to do with our results. Certainly, there is no reason why Sibanye should be not as highly valued as Harmony. So those are the things we look forward to once we've established a delivery record.
Neil, Nerina Visser, our previous commentator from Nedbank Capital, made an excellent point. She sort of put forward the idea that perhaps when you first split from Gold Fields, overseas investors, maybe even local investors, were unused to being able to invest in a purely South African gold mining operation, and maybe overseas investors didn't quite understand how to value the company. Would you agree with that, first of all? And secondly, does your share register back that up, if you like? I mean, have you got a good foreign participation now?
The first part to the question, Lindsay, is that certainly the... sorry, just repeat your first part again.
Did you find that when you first split, people were confused about the valuation of the company?
Absolutely. I think that there's a couple of things. In Gold Fields' hands, these assets were not as visible as they are when they are in Sibanye's hands. That's the first thing. I think the second thing, as assets on their own, they have no real clear history, and certainly under this management team of delivery. So I think investors are, first of all, finding it difficult to value, as you've said. But secondly, I think they're looking for a bit of a track record. And the theme of the presentation today was one swallow doesn't make a summer, but I think one swallow does indicate that there's a change in season coming. And certainly I think that we need another 2, maybe even 3 quarters of delivery for analysts, first of all, to establish a bit of a track record, and also we need to work very hard to help them understand the underlying assets, and essentially that will result in analysts coming up with the right price targets, and investors also, I think, buying into the opportunity. In terms of your second question, We did see a major change in our shareholder. We saw we had about 48% of our shareholder was North American. That had dropped all the way down to 30%. I'm pleased to say that it's actually come back to about 36%. And we've seen some value funds, mostly local, actually buying the stock. So there has been quite a lot of shareholder churn, which also obviously doesn't help the underlying value of your share.
Quite a lot of share price churn as well, Neil, as we saw from the graph just a moment ago. But you talk about putting good quarters together. That's the immediate challenge, isn't it? Because you're now going into a period where you have AMCU as the major union at Driefontein. It might be a little easier with a more mature union on the other two mines, but are you really as confident as you say in the commentary to your results that you've made your plans, or you're rather well prepared for extended strikes?
Alec, I must say, first of all, just on AMCU versus NUM, we see them exactly the same. Perhaps one is a little bit more militant, but they generally come with the same problems. What we do need in the industry is we need strong unions with good leadership. And unfortunately, at this point in time, we seem to be lacking on both fronts. Just looking forward, right at the beginning of the year, we actually chose to go into wage negotiations with a target of something like 2 billion rand of cash in the bank. We know that once you have cash in the bank, your balance sheet is not under threat, and you can sustain a long strike. You are in a strong position, and you will not then be bullied or intimidated into, let's call it, short-term decisions by organised labour. And we've been able to do that. That was very specifically a target. I think the fact that we have also at the same time been working very closely with our workers, we've been briefing them on a regular basis. There's a strong alignment between the gold companies. I think this vicious cycle of above inflation wage increases has to be broken. We are not in this business for the short term, and therefore we have to break this vicious cycle, and we have to get back to normal increases, and we have to look at other ways of getting alignment with our workers. And we've done all of that. And what we can see on site is that our workers actually don't have the appetite to strike. I think they want a reasonable settlement. As the industry, we want a reasonable settlement, and we're working very hard towards that. And I'm actually personally quite optimistic that if there is any industrial action, it'll be short-lived. But the message is that if it's not short-lived, we can sustain an extended strike, and that's obviously not first price.
For how long, though? How long will that 2 billion rand cash in the bank enable you to not be bullied, as you put it?
Well, you know, it's our experience that that extended strikes normally do not go longer than 6 weeks. At these gold prices, that 2 billion rand in the bank will see us through for 3 months. And of course, we've got access to debt. We obviously wouldn't like to use that, but we can certainly withstand a strike much longer than 3 months. And really, I hope that that is not the case. But if you are weak, that will be the case. We are not weak, and therefore I'm optimistic.
So there's a line in the sand there, Neil. There's also quite a lot in your results where you talk about using what you've learned in the past to address not just labour, but also management structures. Are you going to be taking out, or have you been taking out, layers of managers at the mines?
Alec, we have, and you know, a lot of the history and the developments around the Harmony Way are still most appropriate today. They are very good and modern models of management, and we've applied what we believe are the good aspects of that. It does mean removing management layers, not getting rid of your most experienced and senior skills, but it's about getting those skills much closer to the action, in other words, to the face, where that experience can be used to coach and solve problems. So we've taken out 2 layers of management. Unfortunately, in a business like this, where you've had to deal with a constantly reducing production profile. The organization has had to be right-sized. And the way I explained it to the analysts this morning, it's a bit like an onion. You can see the first layer of inefficiencies and you deal with it, because in the longer run, it's to everybody's benefit. So you peel that first layer. Once you've peeled that first layer, you invariably see another layer. And that's where we are today. Unfortunately, we still have a number of excess positions, mainly in our services function. I think we've restructured the rock breaking function sufficiently for now. And unfortunately, there's another round of right sizing, which is going to affect probably another 1,500 people, which is very sad. But as I say, we do this for the long term. We have to take some bitter medicine now.